Hi, and welcome to the latest issue of The Pit, Personal Investment Tools and Techniques for the Active Trader. Please note this is not investment advice. I am not a financial advisor, and past performance is not necessarily indicative of future results. This is for the week ending April 11th, 2025, and what a week it was. Maybe that's an understatement. Key highlights for the week are that the S&P 500 rallies 9.5% in one day. This is the third largest percentage gain since World War II. I'll have more on this later. Gold finished a $200 drop, only to be followed by an over $300 rally to new all-time highs. And crude oil dropped dramatically to almost $55, and then it rallies even more dramatically all the way back up to $63. But let's start with SPX. This chart covers about the last 2 months. I plan to cover numbers 1 through 5 shown in this chart in another video. Today I'm going to just be talking about the most recent 6 or 7 bars. So be sure to check that out when it comes out. Here we have Wednesday's record rally. Price rallied, like I said, 9.5%. That spans 6 handles, for instance, 49, 50, etc., all the way up to 54. Price filled, you can note the continuation gap. There are 2 gaps here. At 5, there's a breakaway gap, which is also a 99%er for my father's 9 patterns. But then you also have the continuation gap, and that was filled at number 6 on Wednesday. Also note that Wednesday completed a 4 closed reversal up, which is a bullish signal. And then Thursday and Friday were also inside days. Like I said, this was a price rally of 9.5%, and it still wasn't the number one rally. The number one rally was in October of 2008. Here's the price action from 2008. The largest one-day move was October 13th, 2008. This day was up 11%. It is marked as number 1 on this chart on the far left. This was followed by a near 11% rally later in the month. This is marked number 2. And then a month after, well, about 3 weeks after that, at point 3, you had a 6.5% rally in mid-November. All great times to be long, right? For those days, at least. Let's zoom out to the bigger picture in 2008. I think you know what it says. We find from the close of the largest rally, that 11% rally on October 8th, until March, early March, the S&Ps fell almost 34% over that 4.5 month time frame. So the moral of the story is always follow the trend on the higher time frame. In 2008 and 2009, the trend was decidedly down. This number 1 record-setting rally in October came on the heels of 3 weeks in which the S&Ps dropped an amazing 33%. Currently, the S&Ps are sitting at their spring 2024 levels. So we gave up a year of gains. That's also right around the Fibonacci 62% retracement level. And that's after completing a Elliott wave, 5 waves up pattern, which carried prices up 50%, which is a great move, obviously. And the most recent down wave is deeper than the prior wave down. So this tells me, and I'll cover this in another video, this tells me that I believe prices aren't done dropping yet. Next, let's go to gold. Gold had a quick 3-day reaction down to its Fib 62% level. This reaction was after a complete 5 waves up. These are labeled 1, 3, and 5. And this move went from 28.40 to 31.60. an ounce, $3,160 an ounce. That's a $320 move since late February, a 10% rally in gold in 2 or 3 months. This week, gold rallied off of its reaction low at 2,960, and it rallied up over $150 to break all-time record highs again at $3,200 an ounce. This was a 5% move. Note that today's move was narrower than both Wednesday's and Thursday's move. This to me means less buyers coming in or more sellers, either or both. Either way, it says that the move is losing steam, and it might be time for a pullback to the Fibonacci 38 to 50% level, around 3,100, or down to that prior high around 3,160, marked 5, the end of the 5 waves up. That would be a drop of maybe $80 to $140, which has to make you laugh. A move like that a few years ago would have been monumental. Now it's just a small reaction. Next, let's look at the 10-year Treasury yield and how it relates to the dollar. Here is the chart on the 10-year U.S. Treasury yield. The yield has rallied an amazing 0.6% in just 5 days. It's gone from 3.9% all the way up to 4.5%. In terms of movement, that's a 15% move in the yields. This is one of the largest moves in interest rates in years. I couldn't find one on the chart. Now, correspondingly, you would think that higher yields would be strong for the dollar, and that the dollar should be shooting higher. People would be scrambling to buy the dollar to get into U.S. Treasuries yielding that 4.5%. They are not. They are, in fact, dumping U.S. dollars. That is very rare and should be of great concern to everyone who uses U.S. dollars. Here is a weekly chart of the U.S. dollar. It has decisively broke through the lows of the last three years. It did find some buyers, which is evidenced by the tall wick at the bottom of this week's candle, where you had some buyers come in today on Friday. Note the upthrust to start 2025, well, to end 2024 and to start 2025. Prices spiked to new multi-year highs and could not hold those levels, and then fell right back down, and from that, the dollar has dropped 10% this year already. This market is key. Don't ignore it. We might have a spring off these lows, or we might continue down. No one knows. All right, on to grains. Soybeans have been very volatile this year, which is to say, no clear trend. That might be about to change, in my opinion. Beans broke the low of this triangle pattern, which has been in effect since February of this year. But prices sprung right back up to break not only back into the original triangle, but 2 days later, actually the next day, they broke out of the upper triangle, upper down sloping line around 10:30. And then today on Friday, they rallied even more, making a new pivot high. A spring, as labeled here, is a test below support, only to find buyers immediately. That's an immediate rejection of the price lows. And prices spring back up, like you're pressing down on a spring and it springs right back up. Note also the foreclosed reversal on this chart. The daily trend is now up. Beans have had a long trend move down from $18, and the weekly trend is still down, but we've got a lot of room before we hit those highs of $18, and a lot of buyers and sellers in there to take the other side of a lot of sellers to take the other side of a trade. Finally, let's have a recap of a previous chart I did 3 weeks ago. I highlighted this NASDAQ chart, this NASDAQ 4-hour chart, and I noted the L formation, the price high in mid to late February, and a dramatic drop with no clear rally, just a sideways action which looks like the letter L. This to me signaled that prices would probably or possibly move lower. And that's exactly what happened. Prices moved lower. Here's an updated chart through today, April 11th, 2025. Price did have a pop up off that gap up just before the blue sell zone, but this was quickly rejected after 2 days. So from that day's close to the low of the move is 17% or over 3,300 points. This move ended with the exhaustion gap down and then a clear out bar forming the low. That's a bar that opens below the prior day's low and then rallies up to within the prior day's high. And from there, we've rallied up strongly from about 17,400 all the way up to 18,690. So you've had about a 2,000 point move. I hope you enjoyed this. Please like and subscribe and let me know if you find this content helpful. Have a good day.